Mate, welcome Mick Butler, my right-hand man, business partner and guru. We're fortunate enough today to be welcomed by Mick.
Thank you, Barry.
Mate, we're releasing this over the Christmas period and festive period, and I'm just trying to make it a little bit easier for people to understand in terms of what we've achieved this year in 2025 and what we as a brokerage do. There's many areas that we specialise in, but today I'd like to really talk to you about buying and selling investment properties and somewhat like debt consolidation. Potentially three tips that you've got for people leading into 2025 with the rates coming down, and mate, any stories that you might have that people that you've helped as well at the same time. But I might start off with buying and selling, if that's cool. Is that okay with you?
Yeah, of course, mate.
So, mate, look, we'll have a bit of fun. We'll snip some of this down for some of the tips and tricks on the social medias that people can log on to and have a look at for 30 seconds. But, mate, we'll rip into it. A lot of people are in the position where they just don't know when they want to sell the property. Well, if they're selling their property and they want to buy another property, what typically do you see people tend to do in that case when they're buying something and they haven't really sold their house yet?
There's some I've actually dealt with quite a fair bit of this, particularly this year, 2024. A little bit in 2023, but it just seems to have been something that's happened quite a lot in 2024 and have got quite a fair few clients in that exact position at the moment. So what I've probably found this year is that a lot of people, their initial thought when they're, because ultimately it's about upgrading their home. Like they've outgrown where they are, or they want something a bit, they want a fourth bedroom or a bit more land or something like that. So traditionally they've outgrown their home and they want to move on to something a bit bigger, nicer, whatever. A lot of people's first thoughts are, which again is traditional, is I'd love to keep my existing property and turn it into an investment and then go and buy the new one. Now, that you've got to be earning really good coin to make that happen now, okay? Because as soon as you're looking at buying a new place that's 800, 900, $1 million bucks kind of minimum in Brizzy now, if you're retaining your existing property, you're borrowing the full tote for the new purchase. And then those loan repayments, your repayments are $1 million bucks. And as soon as I go through and explain that to people and we actually look at their numbers, that's, shit. Okay, we can't afford that. So then it turns to, well, how do we transition from this property into the new one? Okay, how do we sell it and then buy in the same market? Because years ago, you might sell your existing place, go and rent for 6 months. Well, try and find a rental now. And even worse than that, try and find a short-term rental. Because rental properties are so hard to find, if you can find one, they're going for 12-month leases and 2-year leases and that type of stuff, as opposed to 3 months. You wouldn't accept it. So
you mentioned there before income. So let's just give the listeners an example. Average house in Brisbane, call it a $600,000 home loan that someone's got.
Yep.
Looking to buy another property equivalent to maybe, well, typically people are upsizing.
Yep.
Downsizing is a little bit different. But you mentioned before you need to earn some really good cash. And keep in mind, we know interest rates are 6 point at the moment.
Yep.
In 12 months' time, let's maybe say they're another % lower. What are you typically seeing good coin to people? Because the average income, call it 90 grand combined, 2 people, 1 house, 180, 200. They think they're doing well, maybe with 1 child or 2 dependents.
Yep.
Consider a good income, mate. What is out there, do you think?
Well, on that example, if you combine incomes, a couple $100,000, couple of kids at home, and I'm talking no other debts, okay? So no car loans, no leasing, that type of stuff. You can borrow, general rule of thumb, about 4 times what your income is. So if you're on 200, your loan is going to be 800, maybe 900,000.
And that's just to stick to that point. That's with no dependents, 1 or 2, no car loans,
no car loans,
So for any
no HECS,
that's beautiful.
Novated leasing.
So that's beautiful for any little listeners out there. Mick's got over 25 years experience. Listen to that. 4 times your income is general rule of thumb. That's just a helicopter kind of
it's a rough
pitch, of course. Yeah. So you're saying that essentially it would be 300 to 400,000. That's even just probably afford your own house, right?
To afford your own, let alone to the existing one and turn it into that investment property. So that's the change that I've really seen in the last 2 years now, okay? And that's just purely because of house prices.
And are you seeing, so some of the tips for someone that's looking at buying and selling, like I know that we do bridging loan, that's quite popular. People throw that out there.
Yep.
Buying, having it as a sale of your house for a new property that you're looking at buying, which kind of waters down your negotiations and can be somewhat less attractive, right?
Yeah.
If someone was looking at getting a bridging loan,
Yep.
without having that contingency of subject to the sale of my house.
Yep.
What is the LVR, which we call loan to value ratio? What is the kind of bullet points that you'd give some of the listeners to go, hey, you could possibly look at this?
Yeah, well, you do need to have good equity in your existing home. And when you talk LVR, your bridging loan will cap out at 80%. Okay? But the trick to that is the shading that the banks put on it. Okay, so the banks they shade the value of your house, and then they have to factor in that bridging finance could be in place for 12 months. Now, everyone knows in today's market that that's not going to happen. You put your house on the market today at the right price, it's sold on the weekend. But banks don't operate like that. They're historical, they're creatures, they've got policies that have stood the test of time for 50, 60 years, and they build in all these buffers. So that 80% LVR, where got to have your 20% equity, you probably need to have closer to 30% equity.
Wow.
Okay, because of the shading and the allowance for the interest and that type of stuff. So, yeah, if your current place is worth $1 million and you owe $800,000 on it today, bridging finance is not going to work for you. You're not going to qualify for it.
So if you were going to look at it and buying another property for $1 million, I call it collectively the assets are worth $2 million. What LVR would you consider for someone should really consider maybe a bridging loan out there? Would you say 70% LVR?
Oh, yeah.
Okay.
Yeah. So that's if you're at home and you're at the kitchen table chat of a night time and that type of stuff. That would be your first thing. But it is very technical, okay? So to sit down, to go through it, it's just yell out, and that's what we do. So we educate people, we help them come to those decisions, and then you can make an informed decision as which way to go. Yeah.
If you're doing a bridging loan, do you need to pay the bridging loan and your end debt? Because essentially, just for the listeners out there, is that the bank focuses on the end debt?
Well, yes. Yeah, because the bank's not going to give you an interest-free loan, are they, right? So you are you're paying interest only during that period up until you sell your existing place, okay? But it's all built in and it's all factored into part of the deal.
And who would typically do the bridging loans? Is it your big banks? Only big banks will really have the kind of appetite for it.
And even then, some of them, want you to be an existing customer first and all that type of stuff. But there's probably two leading ones that I find that are pretty good with it. Yeah.
How many bridging loans have you come across in the last probably 12 months, do you think? Handful of
dozen, maybe. Yeah.
So I probably would recommend for anyone that's out there, if you are looking at buying a property and you haven't yet sold your existing house, definitely if you've got a bit of equity, reach out to us and we can let you know how the bridging loan works. One tip that I had in the past is if you're looking at selling your existing house and looking at buying a new house, and it's typically not, suburbs are quite close, give it to the same agent so they can get two sales.
Yes, I've got a client that's happening with at the moment. Bridging finance actually worked for these clients, and it's a path that they could have gone down, but their decision was, well, we don't really want to commit to buying a new place until we actually know how much we get for our existing place. So even though they could have got bridging finance, they opted against it. There's a property that they're interested in. Double dip, that's business sense, right?
Yeah. And it's legitimate.
So there's a tangible benefit in there that the real estate agent can actually help with bringing it all together as well. You need that to settle on the same day. So the negotiation for both parties, if you're dealing with the one agent, that actually makes that process, I believe, a lot smoother because that agent knows where the buyer's at, he knows where the sellers are at. If we can agree on a price, well, then to coordinate the settlement and line up the dates with it, that's a lot easier compared to talking to, so it's a good tip.
So 3 tips that you would give for anyone out there looking at, from a finance sense, not real estate, from a finance sense, what would be your 3 best tips for someone looking at buying?
Yeah, we know your numbers. Okay, so before you go out and fall in love with the new house that you want to buy, know your numbers, do your research, have that appointment with us. Let us go through it. We'll tell you what's possible. We can talk you through all those options. So that's definitely the first one because if you go and see a house today that you really like, if you're not making an offer on that in 2 or 3 days, by the time you double back around, it's gone and you've missed it. So be prepared, know what you can do. They're probably all real estate tips as opposed to finance, Baz. The second one is get your house ready for sale. Talk to the agents, find your agent, find out what their commission is, what their advertising is, what they want you to do to a property. Be prepared. Get your house so that it could be ready to go on the market in the next day. From a finance point of view, look, if you've got a shitty little credit card that's sitting around and you don't really need it, cancel it. Get rid of it. That'll affect your borrowing capacity. And then, if you've got a small car loan where you might only, I had this with a client the other day, they only owed $5,000 on the car loan, but the repayments were $800 a month.
Which would have affected their
servicing. So just, after talking to us and going through the numbers, get rid of it, pay it out. It's all about preparation. You have to be prepared because the market's so hot that when you're ready to act, you need to have your ducks in a line or it'll fall over.
Also, as well as that, I'm big on budgeting, right? It's the kind of fundamental basis of any success. This is what I typically find with clients as well, is we really need to go over that budget first and foremost. And if they haven't sold their house and they go and sign a contract on another house thinking, well, they haven't sold their house, they don't need to worry about the finance. Well, you really do need to worry about the finance, right?
Well, start with the end in mind. Okay, so if the end position is where we're going to sell for $1 million, we're going to buy for 1.3, we're going to incur some costs, real estate agent, stamp duty, and all that type of stuff, we can work out to a degree what your end loan amount will look like. And then, as always, that's the most important thing, is what are the repayments on that loan. Okay, so before you do anything else, you got to know what the repayments are at the end of the day.
Do you know also as well, mate, is that for anyone that goes bank related, 70% of the market go through brokers, right? But I suppose what we do differently to other brokers, it's not just a, interest rate, transactional, get in, get out. For us, as you well know.
Yeah, it drives me insane.
And there are plenty of brokers out there like that. And it's like, no, let's talk about, if we want to do this, is there renovations going to happen on the property? What's your future ambitions financially to make sure that you want to be with the right bank? You and I had over the weekend a client email us about a bank online, and it was funny. All he emailed us about was, hey, this is what I'm getting. And it was nothing about the service, 20 years experience between you and myself, 20 plus years each. And it was like, well, if you go with that online bank, knowing full well that can only get cap on to a certain LVR, any future kind of potential wealth that you want to do, you'll be limited. So this is why it's so important, right?
Oh, and that client, he got the fees wrong.
Yeah.
So he's done all this research and he's telling me what it's got. So even then, after all of that, he still had the wrong fee structure. Yeah. So yes, interest rate is very, very important, okay? But a variable interest rate is a variable interest rate. It is at a point in time, okay? So yes, as at a point in time today, that particular bank may have the lowest variable rate today, right? Hopefully the Reserve Bank will cut interest rates, okay? Now, mate, I'm going to guarantee you that...
Well, that's a big call, mate.
When the Reserve Bank does the first cut of 0.25%, I guarantee you that there is no way in the world that every bank in the country is going to pass on that full 0.25% interest rate cut.
Okay, well, you heard it here.
It is not going to happen. Some will pass on 0.12. They might only pass on half of the cut. So what, are you going to go and refinance your loan then, incur $1,000 in costs to then get, I can get 0.05 cheaper at this place? It doesn't work, because then 3 months later, if the Reserve Bank cuts rates again, that bank who did only go by 0.12 this time, they might go the full cut next time. And then old mate who went 0.2 the first time.
The effect.
Yeah, so the point in time, if interest rate is critically important and that's what you're focused on, go fixed.
But also as well,
go fixed, lock it in.
I throw it out there with that guy, right? Does it get under my skin? Well, not as much as what it used to, right? But it's like, I would prefer not to have that type of client, as you would well know, right? Because it's just transactional to them.
Yeah.
For us, as you well know, it's the amount of education that we've helped people understanding debt recycling, investment properties, SMSF, buying it in the right entity. Like, we've seen it firsthand for 20 to 30 years plus. And for when you get the client to email you, number one, for me, it's like, well, you can't be bothered to pick up the phone. That's alarm bells, as you well know. Two, well, you can't just talk to me for 5 to 10 minutes to go, hey, this is what I've been offered. What's your thoughts? My suggestion would be is I would look at the Google reviews for the business, also your personal kind of attributes. And I really would want to know more and get inside your head as opposed to going, hey, you've seen other people build wealth. Can you show me? And that's where I'm alarmed that people are just going, hey, this is the interest rate. This is the cheapest in the market. That's what I'm after. But a home loan is for 30 years.
But that's how people have been educated.
They have.
So it's not, you don't know what you don't know.
But also as well, sorry to cut you off, but there's a reason why there's only 2.2 million Australians have investment properties, but there's 14 million Australians working. I don't know about you, but I'm friends with a few people here like Phil DeBella. I would want to surround myself with people that have done well because I want to learn from them. Yeah. And I'm not saying we've done well, but for me, that interest rate, it is super, super important, but it's all about building wealth, right? Which brings me to the next point, investment properties. God, we could probably spend half a day talking about this, right? Investment properties. As I just mentioned, 2.2 million Australians have got investment properties. That's too low, right? Too low. We've got substantial equity in the house now because everything's gone up so much. Interest rates are an all-time high. What recommendations would you give people looking at investment properties, not properties, I don't want to talk about that finance-wise? What's some of the things that people should consider when they're looking at buying an investment property?
These days, they should consider buying it in their super fund. If you're 35, 40 years of age, you're going to be working for another 25, 30 years. Property is a long-term investment. Super is a long-term vehicle and strategy to have it in there. So I'd be changing the thought process to look at it within your super fund. There's good tax advantages along the way. It is, again, it's that long-term investment. It comes with a downside as well, but yeah, I think that's and again, it's prices because, to go and buy an investment property, even if you look regional, you've probably got to go $400,000 or $500,000 now to buy a property in long-term growth, and that's never going to be as good close to the city or the coast. And again, it's that cash flow. It's can you afford that? People these days, wealth creation's important.
So buying an investment property, sorry to cut you off, buying an investment property, don't quote me on this, 70% of people look at getting rid of them after 3 years because of the costs involved. Is it because the structure's not right, or is it because
they just didn't do their research?
Like the big banks, would you say, own that market with investment property loans?
Oh, probably, yeah. Well, they're the big banks for a reason, aren't they? So it's volume-based.
So if you were looking at investment properties, if you were looking at getting an investment property, would you go interest only or P&I?
No, P&I.
So you're a P&I man?
Oh, 100%.
Over investment property? Yeah.
Well, the reason for that is you've still only got 30 years to pay the loan off, okay? Now, if you do interest only for the first 5 years, well, then you've only got 25 years to pay the loan off. Whereas if you do principal and interest right from the start, those loan repayments will be less, okay? So for the first 5 years, interest only, your loan repayments are going to be cheaper.
Yep.
But for the remaining 25 years, they're going to be more. So again, if you've still got a couple of young kids at home, okay, and say you buy an investment property, I don't know, the kids are 8 and 6, you do 5 years interest only. So your loan repayments will be less. But then when your 8-year-old's then 13-year-old, getting more expensive, and then your investment property's gone from interest only to P&I as well, it's not going to work. So
there's a lot of equity in the property market here in Brisbane, right? For people that are in a position, kids are growing up, mum and dad earning really good, all partners earning 350, 400 plus or 300 plus. Forget about the SMSF for a sec. We'll come back to that. But because they've paid their owner-occupied house down for so long, if they move out of that and make that an investment property, that would make complete sense going P&I because the rent would look after the repayments, right? Don't mind that strategy. Just for the listeners out there, how many terms do you get for interest only? If you were in that same equation, you went, I just want to go interest only.
Oh, well, they say that the maximum term that they will do is 5 years.
Yeah.
Okay. There's one bank that will do 10 years straight off the bat.
Yeah.
Okay. Now, they say they'll only do it for 5 years. you just renegotiate in the 5-year period or refinance to another bank. So if interest only is your strategy, and if that's the difference between you being able to buy the investment property or not, well, yeah, 100% we're going to go interest only, okay? But yeah, just be prepared that in 5 years' time, there is a chance we might need to refinance it, and the next bank will give you another 5 years, okay?
But you're just kind of kicking the can down the street, really.
You are, because you never, then you're just solely reliant on the property growth for what you're going to make, okay? So, yeah, it's just kicking the can, but...
And banks, if you wanted to go interest only, banks from a servicing aspect, they'll give you less if you go interest only.
Because as I said before, if you do 5 years interest only, the bank's not assessing you over a 30-year loan term. They're assessing you over 25 years. If you go to that bank who does 10 years interest only, they're not assessing you over 30 years. They're assessing you over 20. Okay, so it has a negative impact on your borrowing capacity.
Rental income. Why do banks only take 80% of the rental income?
Because they're nuts.
Yeah, that doesn't make sense.
Again, banks in this country have been around for a hell of a long time.
Yeah.
The big banks, right? Mention the likes of those online ones, right? They come and go when they close down, and there's been 3 or 4 of them this year. But your big traditional banks, they've been around for 100 years in this country. They've got policies that have stood the test of time, right? They've got policies that withstood the tech crash in the 80s. The Gulf War, the global financial crisis, COVID. So the banks have got policies that have stood the test of time, okay? You look to our friends in America, when the big crunch with COVID, 7 of their biggest banks, for all the bank bashing that goes on in this country, I don't like defending them, but their policies have stood the test of time and they work. To answer your question, if you go back 15 years ago, there was a fair chance that your investment property would not have a tenant in it for a period of 4, 5 or 6 weeks each and every year. Does that happen today? No, it doesn't. But again, that's city-based. You go out into the bush, out into the regions, I bet you there's vacant properties everywhere. Yeah, so the bank can't have a lending policy for Brisbane CBD, another one for Sydney. They can't have one for Burke. They can't have one for Mount Isa. So they will always shade that rent. Now, the other side to that is that it's actually protecting the consumer. The bank is factoring in and shading that income. So that protects you. That builds some comfort in there to protect yourself as well.
So 3 tips, mate. So 3 tips for the listeners, and we'll finish up because I do want to talk about that consolidation. Investment properties. 1 would be an SMSF. SMSF to potentially look at buying an investment property for people that have got good super. Buying a property that's either tenants in common, if it's an investment between 2 people, or buying it in one person's name with a joint application, whether it be the wife or the husband due to higher income if it's a new property. Outside that, have I got any other structure in a different format? So anyone that's listening right now, buying an investment property, what would you do? Name, structure, trust, SMSF.
That comes down to the individual person and their circumstances. Okay, so all of those are completely valid options. It's just whether it's the right one. Okay, if you're running your own business and you got a company and all that type of stuff, well, you might want to have it in a trust structure for some asset protection. If you've got one high income earner and then a lower income earner, traditionally you put it in the higher income earner's name to maximise the tax deductions. But that works if you flip that property in 3 years' time, because who's going to be paying the capital gains tax? You need
accounts are essential.
Accounts and again the right one. Okay, yeah. We have some fantastic relationships with some very, very good accounting firms, and their advice is spot on all the time. Now I'm talking to a young guy.
So you're saying don't Google a structure, talk to a professional.
Good luck with that. I've got a young client at the moment who's looking at buying and selling because he doesn't want to go down the bridging path. Now, what his accountant is telling him is flat out wrong. So, as with everything, you've got to have that good team of professionals around you. It makes it much easier for our clients when we've got that relationship with their accountant and we can bounce stuff off them behind the scenes, okay? Where it's, oh, look, this Billy said you're recommending this. Tell me about that. Oh, yeah, well, I'm doing it for A, B and C.
I think also as well, like from a broker's perspective, the experience of a broker, I well know there's the popular brand out there, big brand out there in the broker market. That broker doesn't know how to do SMSF. It's alarming as to what's out there for people because a wrong decision could be very costly.
Oh, absolutely.
The wrong structure. But it's not the short game, the long game, right? Another thing, like we saw a lot this year was debt consolidation, right? The amount of credit card debt, equity's gone up, interest rates are really high, a lot coming back down, hopefully. What are the key things that you see with debt consolidation? What are the top things that you see where people went wrong? What are you debt consolidating a lot of?
I think where people went wrong was, when interest rates were low, they went and bought the 2 new cars and all that stuff, okay? The interest rate fixed at 2% for 3 or 4 years, and when that rate comes off the fixed rate of 2% and it's now 6.2 or something, and your repayments, it just comes to cash flow.
It is, isn't it?
It's debt consolidation. There's only one good reason to do debt consolidation, I believe, and that's if you're under cash flow. If you've got pressure at home, cash flow's tight, debt consolidation, if it's something that you can do, it's a great option to relieve that pressure. Okay, but again, that's kicking the can down the road. Okay, you're bringing debt for car loans and credit cards that should be short-term debt. Okay, it should only be there for 3, 4, 5 years. You're bringing it into your home loan, which is a 30-year home loan. And but if that's the difference between surviving, putting food on the table, keeping the roof over your head, categorically it's a no-brainer when it comes to those things. But if you're going to do debt consolidation and then go and buy a new car for $45,000, you haven't achieved anything.
So top 3 things that you give someone if they're looking at debt consolidation, I should look at doing something like that.
Again, cash flow. Yeah, cash flow is king. It's the number one consideration. So the credit card and the car loan, but you're comfortable and you're making those repayments and everything's working, you wouldn't consolidate it into your home loan. It would make no sense too. So if your cash flow is okay, just keep going the way that you are. But if it's not and you need some help and you need some assistance to take that pressure off, absolutely, you should do it.
A few years ago, I had a debt consolidation for a client. They've turned into being friends. Husband and wife, house, bit of equity in it, car, 2 credit cards, quite substantial ones. We consolidated, did the cash flow, got it back to the point where we said, okay, let's pay $500 extra on your home loan. That would shave a good 10 years off the mortgage. The way they were going, they were still going to be paying it off your 25-year term. Yeah. We're now up to an investment property that we did with them. It's like that realisation of that light bulb moment of going, hold on, let's not do this again.
Well, as long as they have that moment, okay, Yeah, I've had clients that have come back 3 and 4 times to consolidate.
It's a problem.
It's
100%.
A spending habit. So it's a Band-Aid solution. You're not addressing what got you into the position that you were. So, if it's credit card, I haven't owned a credit card for 13, 14 years now. Never will have one again. Okay?
Yeah, no, they are poison.
Because when I was younger, I didn't manage my credit card very well. So, when I paid it off, I cut the rotten thing up and got rid of it.
But it can be liberating at the same time for a lot of people, right? To debt consolidate, take some extra cash, do some renovation, because it comes down to, you're married to a psychologist, right? So you kind of look at that behaviour and you're like, well, you've got to give yourself some type of reward. You've got the equity, refinance, maybe do some consolidation, plus maybe do something on the house and really learn from it, right? I don't know what it is. I really quite enjoy debt consolidation for people, getting them out,
Oh, if you like, again, I'm doing it.
I really love it.
Yeah, I've got one going through for a mate of mine in the next few days, and their cash flow was okay, right? So it wasn't, he said, oh, look, if we could free up some money, it'd be good, but if we have to keep doing what we're doing, we're managing. But look, again, it was only 2 small car loans. It wasn't too much damage to the home loan long term. Their existing rate was quite high at the bank where they are, and we've improved his cash flow by $1,500 a month.
And mate, what you can do with that, right?
Well, his kids are now teenagers and getting into sport a bit more and that type of stuff. So for the next 3 or 4 years, it's not making too much of a detrimental, the wealth creation part from the long term. It's okay. And it gives him some relief and they can do a bit more as a family. Then he knows once the kids are 18, 19, okay, well, we need to revert back to those repayments that we were, and we just play catch up, which is fine. It's all conversation, and it's making sure that you're aware of what you're doing, the pros and the cons of it, and then
So I suppose
make a decision what you want to do. But if I see him in 4 months' time and he's gone and bought a new $55,000 motor vehicle, I'm going to kick him in the backside because he'll be back in the same position. And it's not an asset, a motor vehicle appreciation. I think he's taken 2 steps backwards.
For the people that are listening out there, just want you to remember one thing. If you're feeling the pinch and there's debt consolidation that you need to consider, don't think that it's a bad thing. You can debt consolidate, get your back, pay a little bit extra off your home loan to get back on track. We've got equity in the properties now, so people should look at doing it because credit card 17-13%, right?
Yep.
Mate, thanks very much for joining us today. I really appreciate it.
Thank you, Barry. Pleasure.
And for anyone that's listening, Mick Butler, honestly, arguably one of the best brokers that I've come across in my time, and I'm very fortunate to have him our business partner. Mate, thanks very much, champion.
Good on you.
See you, mate.